top of the 20 trillion, which is 30 trillion. And if Trump gets his tax cuts and infrastructure, it's like another 10. So you're going from 20 to 40.
Right.
Okay, you're already paying around 600 billion in interest on it. And if interest rates go up or you double the debt in 10 to 20 years, you're looking at $1 trillion in interest per year on top of everything. So at some point in time, you can't do it. You're going to have to raise taxes somewhere to buy down the debt to get the interest tax component, the interest component down, because at some point in time, you're not going to have enough tax revenue just to service entitlements, defense, and interest. And interest is the fastest growing component of the budget. So they're going to have to address it. Where do they go to get it? It's going to be real estate. And it's going to be, they're going to have to go to corporate taxes too. Because total tax revenue to GDP in the United States is fairly low. And they've been going down over time. So as a percentage of tax revenues to GDP, corporate tax revenues to GDP, we're at historical lows. So where are you going to go to get the money? Tax revenue, you go to the corporate income tax at some date in the future, and you go to personal income taxes, and you go to real estate. So it's coming.
Well, my mom's house is covered under Chapter 13.
Oh, so you filed?
Oh,
you mean Prop 13?
Prop 13, yeah.
Okay.
Yeah,
so that's pretty good, but again, the question's going to be for you, if your mom owns the property, is it in a trust?
Oh, yeah, it's in a trust.
Okay, perfect. So you're going to get the stepped-up basis when she passes away. Okay, perfect.
Now, are they going to try to get rid of the
they want to eliminate the estate taxes.
Okay.
Okay, and right now it's if you're over the 5+ million for a single and 10 million joint for married couples. If you're above that, it's at 40%.
Yeah,
So they want to eliminate it.
I have friends that are going through that right now.
Hey, for the event?
Yeah.
Awesome.
So they want to eliminate that total. Okay. But again, that's a pretty high bar for most estates to get through without having to pay the estate taxes.
Right. Which is 50 to 60.
Right now it's 40% over the 5 million or over the 10 million joint.
And that's including all the fees?
No, I didn't.
Yeah.
No, that's just gross. That's just marginal.
Okay.
So you got to work with your tax accountant to be able to figure out, what the total tax burden is going to be.
Who are you recommending these days?
On the trust or the tax side?
Tax side.
I got a guy who's really good. His name's Ralph Bungie. He's right around the corner. Do we have any of his cards, Wayne?
I don't believe so.
His name is Ralph Bungie.
Bungie?
Yeah, I can give you his number.
Okay.
He's a really good guy.
Ralph.
Got his MS in tax at Golden Gate. I really like him. And then the other person is, hold on. Her name is Stephanie Prophet. Francine Prophet.
Oh, Fran.
And her number is 415-541-4990.
4990.
Yeah, she got her MS in taxation at Golden Gate too.
Okay.
And then Ralph, he's really good. His number is 415-987-5431. And if you need any others, we can provide you with some other tax, trust, and business attorneys and accountants if you need those.
Okay.
And then I was asking Mary Ann,
Anne-Marie.
Anne-Marie, I was asking her what she wanted to focus on, and I've already started to help her on some stuff.
Cool. So my name is Robbie, by the way.
Nice to meet you.
I work for a home staging and interior design firm in San Francisco.
Okay, and then you're
I'm a realtor and a notary loan signing agent.
okay, San Francisco?
Yeah.
Residential?
And commercial.
All over?
Yeah.
Okay, cool.
Yeah.
Nice.
Yeah, so we focus primarily on residential, high-end residentials.
I'm up in Maryland Park. Do you have anything up there? Or doing a lot of condos?
We're mostly in San Francisco.
Right.
So
Maryland Park,
where's that?
off Portola Drive,
Okay.
Monterey.
Okay,
Yeah.
sounds good. Yeah, so I'm on the, I'm a CPA, so I'm more on the finance
Okay.
and the business, strategy and growth side.
Yeah.
Oh,
So I'm
nice.
not out there on the field kind of estimating, project managing. So I'm interested, I guess, just in kind of the real estate market.
Okay.
Um,
Because what I do is I can do, you know, high level global.
I'm here for just kind of, I was just basically everything in the headline and the, you know,
That's
caught my
what I was
eye, you know,
Oh,
so
okay,
I'm just
cool.
kind of,
We were going to go through some of the Trump policy
sounds great.
analysis
Yeah.
as kind of a kickstart.
Yeah,
And then I will go into some discussions on fiscal policy
Mhm.
and then interest rates.
Okay.
Because interest rates are going to determine the business cycle.
Yeah,
And
yeah.
really how long the real estate cycle is going to
Mhm.
last, because it's totally correlated.
yeah.
Okay, so I can go through, just go through the presentation really quick. I'm not making any recommendations.
Okay.
Mhm.
Okay, that's full disclosure. If you wanna work with us on the advisory side,
Mhm.
because we do financial planning and advisory, if you wanna work with us, we can help you in
For
planning.
You do for businesses and personal?
Yep, financial planning, and then we specialize in annuities, life insurance. We have active and passive equity and fixed income management services and product. And then I'm the real estate expert.
Okay.
So I have expertise in the finance
Mhm.
side, but I'm also been in real estate research and brokerage and advisory, you know, for 25 years. Okay. So that's unique, right? Because most of the finance guys don't have any real estate background, and the real estate guys don't have any finance backgrounds, you know, in planning and stuff. So I bring both together, okay? But I'm not making any recommendations, all right? And then I look at really this whole investment, both in planning and in real estate. You gotta be really a big wave surfer. You gotta be really good, you gotta be fit, you gotta be educated, you gotta be strategic and tactical and operational wise, and you gotta be able to do it over and over again, even if you get wiped out and get totally taken out on the sets. So I look at, you know, my career is basically very similar, and I do surf. There's a lot going on globally, you know, especially what's going on in Syria and Iraq. You know, that does have implications and ramifications. Aggression by Russia in Eastern Europe and in Syria, that has implications, ramifications. What's going on with Qatar in the Middle East, you know, has implications on the oil market, you know, the capital markets. You got issues in South Africa. Seems like Australia, New Zealand has held up really well. India's held up fairly well. If you look at Japan and China, Japan has been, you know, conducting unorthodox monetary policy and massive money printing for years with really no inflation. And then you have massive capital flight coming out of China. Almost $800 billion is flowing out of China into Japan, causing the yen to appreciate as opposed to depreciate. And then you got massive capital coming out of China into New Zealand and Australia, the Bay Area, LA, United States, because they want out, right? Because they have very high debt levels there, both on the bank balance sheets and in their own government corporations. So something could go wrong there at some period of time. Brazil's in a recession, political nightmare. Argentina, political nightmare, hyperinflation. So you have basically instability across the globe, which makes the United States, barring the current political environment and the presidency and, you know, who controls the Congress, massive capital flows into the United States, into the dollar, and into our bond market, you know, and our stock market, and our real estate market. So those capital flows in have caused the stock market to continue to go up, the bond market prices to continue to remain relatively high, and capital flows into real estate, which has propped up the prices. Okay, so we're kind of a bastion of stability, you know, on a global basis. I'll provide you with the deck. I look at real estate as a multidisciplinary asset class. You have to understand the accounting and the finance and the econ and public administration, the politics, that is then becomes law, that's administered through the bureaucracy, and then have the economic impacts, all the way down through to the local asset or the property portfolios. And then our system is a Western philosophy system, it's a European-based system. But really, you have to understand, how all of these interact and react to each other, because what we're trying to do at the end of the day is forecast the value of real estate equity. And if you understand how these all play together, and how one variable in one model affects variables in the other models, and how it affects the value of real estate, you can then move forward and forecast where you think the valuations are going to go in the future, and either hedge the position or sell when it looks like it's going to drop, or take a position when the values look like they're going to go up. Okay? And it either could be for real estate as an asset class, or it could be specific by property sector, property type, and geographic location, all the way down to the census block, if you want to drill into that level. So it's a multi-institutional model, and that's why I'm so passionate about education. I'm going to go through some of the philosophy, but I can get to the political analysis. And this is public choice theory with a mean voter theorem model. And it basically lays out the political spectrum to allow you to conduct a political science. Because in my view, at the end of the day, is politics and policy has an economic effect on the value of real estate. Do you understand that? Are you asking the question, if Trump is elected and the Republicans control both the House and the Senate, and Trump is allowed to basically select 3 Supreme Court judges, what is the impact on law, politics, and policy? That may have a direct or indirect impact on the value of your portfolio and your real estate. You got to go up the chain from the microeconomics and the financial analysis into the political and policy analysis. And you can really see the spectrum. It's called the mean voter spectrum. It's a normal distribution. But if you go back, and I use presidencies as demarcation, basically the rightward shift in political ideology of the last 30 to 40 years. And we had obviously Roosevelt and Eisenhower and Kennedy and Johnson and Nixon, and then it really accelerated to the right with the leveraging of the rightward ideology using cable TV under the Reagan administration, and the Jim Baker, the Christian Coalition. And then you saw the acceleration of the rightward shift under Bush 2 and the introduction of Fox News, and basically mobilizing extreme right-wing coalitions and getting them to the voting booth and getting their representatives elected to both the presidency and both houses of Congress. And then Trump pushed the spectrum even further to the right. But the right was already established under the Tea Party and the Koch brothers and other major influential individuals within society that had direct input and impact through lobbying into the policy process. So it was basically an authoritarian takeover of the democratic process. And you saw McCain and you saw Romney, that when they were running, they won their party, elections, they won the representation for the presidential election, but they could not move to the right of center, where the political spectrum had shifted under Reagan. So the new right moved to the right, Reagan kind of set the bar, and then Clinton basically took his leftward coalition, moved them to the right, and replaced the moderate Republican Party, as the new progressive Democratic Party, right of center. And then Bush 2 and Trump and McCain and Romney and the Tea Party and the Koch brothers moved the political spectrum even further to the right. And McCain and Romney could not win the general election because they would win the extreme right coalitions, and then as they tried to move back to the right of center, they couldn't go back far enough. And the Tea Party and the Koch brothers and the conservative elements had a leash on them, so they couldn't go far enough to the left to win the general election. But the populism that emerged in the last election was basically the disaffection and dissatisfaction of the majority of the voters across the United States, because this heartland here was the industrial base and the agricultural base that had been completely disrupted by international trade. And the areas that benefited the most from international trade were the coastal areas, the port cities, the 24-hour cities, the entry points. And that's where the concentration of the infrastructure, concentration of intellectual capital and international capital was concentrated. These are mostly democratic jurisdictions, the rest of it were Republican.
But isn't it historical that the coastal economies, give most of the business to the Middle West? They're the ones who
Yeah,
do the
we
sales
pay
people.
more in
Yeah.
than we actually take.
Yeah.
But they got completely disaffected over the last 20, 30 years because of the deindustrialization of the heartland.
Okay.
So as, international trade under NAFTA and other world trade agreements basically opened up the United States to international competition from China and other emerging economies
Right.
that had basically liberalized their economies,
Yeah.
liberalized their did mostly representative democracy under a parliamentary
Right.
system, opened them up for capital flows to come in to basically finance the development, their industrial development.
Well, we financed their business and now they're spending their money here.
Yeah, so there's some
Yeah.
circularity. But what happened was a lot of the manufacturing and the agricultural, even though ag was protected, it was mainly manufacturing that basically had been completely wiped out and outsourced to the international markets. And then the people who were left were competing at world rate wages now, which basically lowered their standards of living. And after 20 years of living on food stamps and not even being able to afford education or job training because there was no job training programs, at some point in time they said, fuck it, the Democrats haven't done anything for us. We're gonna vote in a populist president and see what he can do. Okay, and where that's playing out over the last 6 months. And basically who he's representing is really the ultra right-wing conservative constituencies of the party, mainly the white Southern Republicans and the corporate elites. You can just see it in the policy. I mean, it's pretty obvious when you look at the healthcare bill and just wait till taxation and infrastructure policies come. You can really see who the real representation is. And he's basically selling out the 22 million, people who now currently have healthcare that aren't going to have healthcare. And what about the other, 20 million on top of the 20 million that don't have healthcare? So you're looking at 40, basically. So you really see the politics, but I think the thematics really lay out. And if I overlaid it, personal income or income growth or GDP, it would look the same, right? It would be really low in here, and then there'd be high concentrations of industrialization of wealth along the coast. Okay, so that's kind of the political dynamics. And then really I did some sociological research on the aftermath of the election to really look at the social demographics of who, voted, him in. 60% of Republican voters are over the age of 50 and 70% are white. Okay, so you really can see 86% are 50-year-old white males, 43% educated, and actually 30% Hispanic voted for him, too, which I thought was interesting. There was more Hispanics and women that actually voted for him than everybody is really talking about. And it's, he was attacking women during the process, going after abortion rights. Millennials were completely out of the picture. They didn't participate at all.
Right.
And that's going to be the new mobilization, because those guys, the millennials and Gen Y, are bigger than the baby boomers. So that when that wave of political engagement sets in, it's going to revolutionize politics. It'll be interesting to see what they do, and if they're even intellectually capable of making political decisions. I'm not convinced, that your generation or younger is completely engaged and educated in the political process, or even understands history. And then the lowest turnout in African American turnout. I mean, Obama basically brought out the African American vote. They didn't even really participate this last time. They were totally disaffected because they were attacked, right? They were being demonized. You started to see in the Hispanic and the African American communities basically social psychoses, neuroses. We didn't see really pathologies of social behavior, criminality, except for maybe the assassinations of the officers in Dallas, were probably the pathological manifestations. There was a direct attack on the democratic process, the voting system, attack on the free media, attack on liberals, attack on elites, and really intellectuals. Okay, and you've seen these kind of progressions in other authoritarian regimes across the globe if you studied history. Cultural segregation, which I thought was interesting, through pop culture and media, television. You know, country music, constituencies of the, you know, the heartland, and you got hip hop, you know, on the other side. And then just, you know, the potential for judicial realignment. So I kind of looked at just the psychology, because I thought it was important to understand that. And then there were some immediate effects, you know, associated with his policies. The assumption was that if you got, you know, deregulation, tax cuts, and infrastructure spending, it would have a positive effect on a multiplier effect in the economy. It'd be fiscally stimulus, okay? The problem is that now it looks like a lot of that fiscal stimulus anticipation of it has basically gone away because the dollar appreciated, interest rates went up due to anticipation of higher inflation due to more growth. The 10-year treasury now is back to where it was prior to the election, and maybe even a little bit lower. So all that anticipation of stimulus and growth, the market's not convinced anymore because they're convinced he can't get health care through, so how's he gonna get infrastructure and tax cuts and deregulation through? So he may actually be lame duck within 6 months, unless he works in the house. Both houses work with the Democratic Party to bring together more pluralistic, centrist policies that they can align on and then pass. But I just don't see the political environment being conducive to that. So we talked about infrastructure spending, military buildup. He's already talked about that, particularly the South China Sea, building aircraft, weaponizing local police departments, making sure they have, you know, heavy artillery and military. He's already moving in that direction.
I don't know how long you've lived in San Francisco.
30, 40 years.
Okay, well, I used to be a chauffeur for a while, and I'd go out to the airport. They actually handmade a tank, the police department. I mean, they got out there, they got the armor, and
They actually made it.
And
Wow.
they had it sitting out there.
Wow. Yeah, because a lot of the military, because after the Middle East, you know, the Iraqi war and the Afghan, there was so much surplus stuff that they couldn't leave in the Middle East, so they brought it back and they gave it to the police departments. Okay, so he's very promoting.
Well, and the FBI gave the San Francisco Police Department 2 helicopters and crashed one.
Yeah. So you're seeing a militarization of local police departments, and then he's asked for NATO compensation, you know, for protection in the Eastern Bloc, you know, due to Russia. But he wants our deal was after World War II is that the dollar will be the primary currency for international transactions, which would lower our cost of capital, particularly for financing the government and the corporations. In exchange, we would pay for military protection for the world. Okay, so by going back on that and asking for more compensation, there could be a dislocation or basically a debasement of the U.S. dollar as the currency of international transactions. Okay, and China wants the yuan, obviously, or the renminbi to be a currency for international transactions. We talked about taxation. He wants a reparation holiday for the $3 trillion that are sitting offshore in Google and Facebook and, you know, all those corporations that are holding on to cash offshore because they don't want to bring it back.
Yeah, they've been very vocal that they're not bringing it back.
Yeah, but he wants to do a tax holiday, so that you'll instead of paying the 30-something% corporate income tax on it, we'll drop it to 10%. You bring the money back.
Right.
But what'll happen is that money will come back and then it'll be distributed as bonuses and salary to the senior executives and be paid out as dividends to the shareholders. Or it probably won't even do that. That would actually be really good. What'll probably happen is the money will be used for share buybacks, which just concentrates more power in the few hands that actually own the shares, as opposed to a distribution of dividends to the shareholders. And if they did that, there would be a huge wealth effect. And there would be a multiplier accelerator effect because people would have more discretionary income and they would consume the majority of it. So it would be extremely positive.
Do you know what countries they have their money?
The majority of the money,
Yeah.
it's mostly multinational corporations, so it's gonna be the biggest markets. So it's probably
Isn't
China and Japan.
Apple holds something in Ireland.
Yeah, that's a tax preference jurisdiction.
Yeah.
So they hold a lot of money there because, like the Cayman Islands and others, it's I forgot what it's called, it's a
Economic,
like an economic zone or a
Yeah.
jurisdiction
Yeah.
that allows them to circumvent, and have very low taxation on their holdings.
which Ireland's kind of ticked off right now about, but yeah, they're trying to get money back from them for misrepresentation and stuff like that.
Yeah, so they're looking for and then he's also trying to lower the corporate tax from 35% to 15%. Hasn't really talked about, any personal income tax reduction, so it's mostly targeted to people who own appreciated assets such as stock and real estate, and also for corporate tax relief, okay? And then lower capital gains, okay? Deregulation, trying to go after Dodd-Frank, okay? The fiduciary rule, I think, is a done deal for January.
January 2018.
Yeah, so we're already gearing up here in-house to put the compliance in place, so that we have everything documented, and all the fact finders and the disclosures and the investigations on our clients, so that when we make product recommendations, it's suitable for the client, we have all the compliances in place.
So what's the benefits of the deregulation?
By lowering, theoretically, the lowering of, or dismantling or diluting of Dodd-Frank, under the Volcker rule, banks have to hold higher capital requirements.
Got it.
Because what happens during the financial crisis, they didn't have a lot of capital, they had a lot of leverage,
Right.
and they had bad assets, and they had derivative securities. So if you did a valuation, on the bank, it would be insolvent.
Yeah.
Okay, after you took into consideration all the accounting adjustments. So by watering down Dodd-Frank, theoretically, the banks could lever up their balance sheets again, bring down the capital requirements, and in my view, creating, again, adverse selection and moral hazard, issues, bad incentives back into the system, that they would lever up because they know that the Bernanke put or the Yellen put or the Greenspan put is always in place, that the monetary authorities could always print the money to bail out the banking system. And we're still in the hole about 4.5 trillion on that, and another 5 on the fiscal side. So the total cost of the financial crisis, in my view, is about $10 trillion, which is a shitload of money. And if you basically do an actuarial out for 30 years, it's probably around 30 trillion. Okay, and I don't think you can do it again, right? You probably got a couple of shots at that. But I don't think you can continue to do that. So it's basically what it would be is a dismantling in favor of Wall Street.
Yeah.
Okay, and they've been pretty adamant at chipping away at it,
Okay.
since it was enacted in 2009. Okay.
Now they have to behave, they don't like behaving.
No, they don't. They like to wreck the system and then have us bail them out. And I'm being totally honest here.
Yeah.
Okay, and you can see where my views are. I'm just a critic. Okay, I'm not really a proponent of a lot of stuff, but I'm more of a critic as a risk manager, because I don't like to lose money. Okay, either me or my clients. Then they want to repeal Affordable Care. We know where that went this week. Okay, I don't think they got a shot at it. Okay, they need the Democrats to be able to do it. I think they use the existing system and modify it and make it better, instead of replacing it or repealing it. That would be a fucking disaster. Okay, and it would have a direct impact on the economy, because premiums would go up and there's your discretionary spending right there, wiped out. And then he wants legislation on drug makers, So there needs to be something done on a policy level to bring down prescription drug prices, okay? I mean, Bush did a good job of pushing through legislation where the government would support prescription drugs, provide subsidies.
Right.
But there was no incentive to control costs,
Right.
okay? So they were basically using the system and they knew they could raise the prices as high as they wanted, and the government was gonna pay for it.
Well, one of the big ones on that one, which is just a disgrace, these people should be shot, is the
Yeah.
drug that,
Like 10,000 a dose or something like that.
Well, it's actually, they have this, now that they have it here, it's a 3-dose. In Canada, it was a 1-dose for opiate addiction,
Okay.
and it's done. It goes into the brain and it just corrects it.
Oh, really? Interesting.
Yeah, that's it. And then it's been on the market in Canada for 15 years.
Really? Wow. Because there's an epidemic here.
Yeah,
And obviously the drug makers are profiting
Yeah.
from it.
stuff's expensive. On the street, I think it's $30 a pill.
So he's also proposed term limits, but I don't think Lindsey Graham and Mitch McConnell are gonna go for that. So that's probably off. Those are just some comments. Climate change, I think we know what's going, he's out of Paris, okay? Corporations are still in favor of it, local municipalities, along with the state of California and other, progressive states are gonna continue going forward. And I think corporate America understands that that's where the opportunity for economic growth and profitability is in alternatives. And if we don't do it, the Chinese are gonna do it. And they've already came in and basically taken over the solar cell manufacturing industry from us. And then promotion, again, of coal and fracking. So we'll see what happens here in California,
Now,
particularly Monterey County.
what was the news today from Sacramento about, are they going to sanction the people that are going to build are bidding on the fence? Is that what's gonna go?
Yeah, that's what they're trying to do. And local municipalities
Yeah.
are trying to do the same thing.
Okay.
I don't know if it's enforceable, but it'll be.
Well, if you don't wanna give them business, you don't wanna give them business.
Yeah, and the wall's really kind of did the Berlin Wall really, was it effective? Well, yeah, because they have military people on the wall. But, are those walls really effective? No. Is it gonna cost a lot of money? You might as well multiply it by 5,
Right,
but it's
right.
really gonna cost. So again, it's really just another subsidy to infrastructure companies. Immigration, again, what do you do with the 11 million? Are you really gonna put together detention centers and warehouse them, and try to export them, on a institutional basis? Kind of harkens back to Germany, 1943 to me. Probably not as ruthless, but again, what's gonna happen to these people? As opposed to co-opting them, putting them on the track to citizenship, creating basically an annuity, along with their kids in an annuity, and being able to provide them with public goods that then they will generate tax revenues over a multi-generational period. The net present value is positive, right? The IRR is through the roof. If you look at these people as human capital, they are gonna pay into the system if you get them on a track, and you promote immigration. Because we need replacement. We went from 5 to 1 in Social Security, right? 5 people were paying into the system in the 70s for 1 recipient. Now it's basically 1 to 1 and dropping. You need people to pay into the system to support Social Security and Medicaid. Going after the trade deals, okay? Wants to do bilateral agreements as opposed to multilateral agreements. I can negotiate a better deal, okay? The auto industry is probably gonna get hurt the worst, okay? Because they manufacture in the maquiladoras, bring the parts in, assemble them here in the United States, and sell them. So Mexico is gonna get hurt significantly, and particularly the auto industry. He wants to impose 45% tariffs and quotas on imports, into the United States to protect our industries.
Yeah, but how's that going on fruits and vegetables and things? That's what we were, people are talking about, because,
Well, California generates about $80 billion in, economics around ag. It's huge.
but
It's
they
eight
export a
billion.
lot of it, don't they?
We export a lot of it, basically into the South,
Mhm.
into the Pacific, the desert mountain states, particularly Vegas and Phoenix.
Mhm.
We feed into that, and then we also export to Asia.
Right.
So Monterey County is unbelievable. It's like $9 billion, in economic benefit, hugely productive, very profitable. They're gonna get, basically, they could potentially get hurt, because their exports are gonna drop significantly, and we're not gonna have enough domestic demand to back, to back that up. So that's another industry that could be hurt. What else? What was my comments? The Trump platform resulted in significantly higher fiscal spending across a broad range of categories, some of which, particularly infrastructure spending, have historically had a significant impact on the overall US economy. I do have a slide on infrastructure spending. The multiplier effect is like 5, okay? Where if I spend on infrastructure, the multiplier effect is 5, okay? If I lower taxes, the multiplier effect is like 0.5. So tax cuts are really redistribution. So if you really want to stimulate the economy, go after job creation, it's gotta be infrastructure, okay? But he wants to use, as opposed to direct subsidies into infrastructure projects, bringing in corporations and providing tax credits. So it's a different types of financing mechanism that nobody really talks about.
Is the multiplier still 5 for that?
Yeah, I can show you the slide on that, because I thought that was really, really interesting. Here. So infrastructure spending, and this is based on research, the Congressional Budget Office, which is pretty good, shows infrastructure spending with a 1.4 and government outlays at 1.2. Corporate income taxes, in some cases, have really low multiplier effects, okay? So the key is down here. Short term, there's a boost in jobs and aggregate demand, from the $1 trillion infrastructure program that he's talking about. What's interesting, based on Baxter and King, is the long run multiplier effect. So there's short term, and then there's long term. Because once the projects are up and running, the economic benefits really start to hit.
How do you define, short term, long term?
Short term is like within the first 12 to 24 months.
Okay.
And then long term is at 5 to 6 years out, okay? So the long run multiplier effect from public investment is 2.5 to 7 times. So you get an immediate multiplier effect, then you get a huge one later. And I'm saying if they could get this stuff through, we're probably gonna be in a recession in 2021 through 23, which is that 3 to 5 year period. If we could get that stuff done now, we get stimulus, and then the multiplier effect would kick in when we're in the recession, which would be extremely a fiscal positive. And I can get into the economics of business cycle theory too. So I was seeing a peak multiplier effect in 2023, which would be the tail end of the recession. And I'll show you the economics around that.
Excuse me.
So the data is already with the research has been done. Okay. Did you have any other questions?
Not yet.
I think that was kind of the high level stuff with the policies. I think I covered pretty much everything from the political scientific analysis. Okay, unless you had any other questions.
No, I'm just flabbergasted. I'm just waiting to see, what happened, if anything's gonna happen with his little luncheon today and.
What was today?
Wasn't it Congress or the senators that he was having lunch with today
Not
to
sure.
to try to manipulate the vote?
Yeah, he's probably gonna slap him around.
Yeah.
He said he'd be really angry at him. He'll probably yell at him.
Doesn't work.
So what, you wanna talk business cycles?
Sure.
So what I did was I did some research. I'm gonna jump around a little bit, and then if you have any specific questions, I can jump around to the data, okay? As opposed to going through the whole thing, which would be mind-numbing. So my thesis on the business cycle, which I thought was really interesting. Let's see if I can find it. Is the business cycles are very persistent. Okay. They're very persistent. So what I did was I didn't use gross domestic product, which is a coincident indicator that tracks the overall business cycle. I used employment, because in real estate, that's the #1 factor that drives demand for real estate space and investments. So I could basically build a model, and I have built forecast models. The majority of the model, if I want to predict rents or prices of residential or commercial, If I just had, job growth as one variable in the model, I could predict like 75 to 85% of the influence, on the valuation. If I have a supply factor in there, it gets even better of a model. But so it's jobs at the end of the day, is the number one factor. So what I did, and I have the data on a monthly basis. So I have jobs, non-farm jobs, at a level on a monthly basis, so I can do year over year.
In the United States?
Yeah,
Okay.
on a monthly basis. So I can look at the overall business cycle for the United States measured by jobs, okay? Which is a lagging indicator, but that's okay, because as you can see, it's still cyclical. So I went back to 1940, because I wanted to see what the pattern of business cycles were going back post-World War II. I've gone back 150 years prior to World War II. It's pretty persistent, but the economy changed so much. After the war, we basically industrialized that you really have to use post-World War II. Okay. So what I did was I bisected the decades into 10-year increments, and then bisected the decade time periods into 5-year increments. And then I went back and I coded the recessions, and I coded the growth peak phases of the business cycle. Then I realized that first, that most recessions occur within the first 5 years of every decade. And I calculated a 90% probability. So there's a 90% probability of a recession in the first 5 years of every single decade. That's persistent, okay? And it's been persistent over time, okay? And we've been in the growth peak phase of the business cycle 70% of the time in the last 5 years of the decade.
Last one.
Yep, 70% probability of growth peak in the last 5 years, 90% probability of a recession or recessions in the first 5 years. It's pretty persistent. Okay. The 2008 and the 1958 recessions were the only two recessions. Post-World War II in the last 5 years of a decade. And actually the 2008 recession bled into 8, 9, 10, 11, and 13. So since it was twice as long, most recessions are 2 years, not 4. It bled into the first 5 years of the decade. So it's still theoretically correct. And that probability is probably higher. So what does that mean? Well, since we're 1 year beyond the natural length of the recovery period of the business cycle, as we continue to go along, there's a higher probability of a recession. The recession should have happened already, okay, theoretically. So there's a higher probability. You are seeing deceleration in some economic indicators that are analogous to beginnings of prior recessions. Okay.
And remind me, the definition of a recession is
3 quarters of
it's
negative
3
gross
quarters?
domestic product.
Okay.
Okay. But I use other economic indicators for confirmation. Okay. Some are leading indicators. So I like to look at leading indicators, coincident indicators, and lagging indicators, for not only for prediction, but also confirmation. Okay. And then duration. Okay. And I'll show you a graph after this. But the point here is that if you kind of look at sovereign debt loads, and you look at other economic indicators, and look at inflation rates and other factors, there is a higher probability of a recession between April of 2018 and April of 2019. So that's basically a prelude recessionary forecast. Okay. But I'm forecasting another severe recession, or at least a recession analogous to prior recessions, because you can see, if you go back in time, the contraction of GDP has been around 3 to 5%, going back in time over multiple cycles. So that's like the natural support, right? The last recession we were down like 9%, okay? So it was twice as deep, twice as long, okay? How long is it? April of 2018 through April of 2019, that's only like a year away, right? And then 2021 through 23, that's like within the next 3 to 5 years.
Yeah.
That's strategic planning, tactical planning, and operational. So you have to have those forward-looking perceptions to be able to put in business plans in place to be able to be defensive, and then opportunistic, to take advantage of the recovery period coming out of the recessions, or opportunities that may be presented to you. Maybe a competitor gets forced into selling its franchise. You take over its market because you have a better balance sheet and better cash flow. You pick up real estate assets at the bottom of the cycle or prior to the bottoming of the cycle because your balance sheet is in better shape and you have cash on hand to be opportunistic to poach basically the assets that meet your profile.
There was a carpet cleaning company in South San Francisco that was in business for years. And what he would do is he'd sell his business, he'd make money, the business would go down.
And you buy it back.
Back.
In arbitrage.
Yeah,
Yeah.
this went on for.
I know
15
guys
years.
who've done that too.
Yeah, O'Connor, yeah.
But there's certain behavioral characteristics of the current recession. It's L-shaped as opposed to V and U-shaped. The big area, it's a V-shape because of the technology industry. And its physical attributes allow the recessions to be quicker, okay, and come out of it quicker, sharper. And then other markets like Seattle and Boston and other places where you have high concentrations of highly skilled workers in very productive central business districts also recover a lot quicker.
Okay, what's gonna happen in Texas with where the, tech, San Antonio.
Tech in Texas,
Yeah,
that'll probably hold it fairly well. But
Yeah.
again, in the real estate side, you gotta pick your submarkets
yeah,
and your neighborhoods, because as you go further out,
right,
you have a lot of land and there's supply shocks that can hit. And obviously the quality of the tenant credit
Right.
degrades the farther you go away from the medical center or the airport or whatever the growth pole, is. And that's one way to immunize yourself in those types of markets. But there's been some permanent damage to the economy, okay, in areas of the economy that will never recover again. So either you stay there and you get government supports, or you migrate and immigrate to other areas of the country where there's a higher probability of job opportunities. Okay. So I think that's that. You want to talk interest rates?
yeah, what's gonna happen?
Yeah, let's talk interest rates. Because interest rates is a predictor of
Well, for
The business
qualifying
cycle.
for loan and,
the Fed basically brings the punch bowl
right,
with the booze. Everybody drinks, gets drunk, it's fun as hell, and then at some point in time, either you're out of the juice, or the Fed basically takes the ball, the ball away. And the Fed admitted, Janet Yellen admitted, I believe it was in April in Aspen, she admitted, she said the Federal Reserve has been the perpetrator and the cause of every single recession post-World War II. They initiated it, okay? And their motivation is basically twofold. One, to basically pop asset price bubbles, and two, to quell inflation. Those are basically the two main motivators that the Fed has. Now, we don't have an inflation issue, okay, because inflation's running at around 1.4, 1.7% using the consumer price index. It's not 5 or 7. So they're not raising interest rates because of inflation. They're raising interest rates because of their concern of asset price bubbles in commercial real estate and the stock market. Okay. So what I monitor as a predictor, sorry about that, I clicked the wrong one. What I track, not only do I track monetary policy and monetary policy statements coming out of the Fed, because they're going to be somewhat leading, they're going to start to introduce language to signal the marketplace, okay? And the smart money, particularly Wall Street money, is going to take cues from the Fed, because basically the Fed represents Wall Street, right? So,
Do you think Yellen is gonna be reappointed or reelected?
probably not. Because her focus has been mainly labor participation rates and labor policy. She believes you can run a lower unemployment rate and a higher inflation. Although they're starting now to raise rates.
Yeah.
Okay. She's more of a Keynesian, where Cohen and the other guys from the Republican side are more supply side economists, monetarists under Milton Friedman. So it's basically political economic ideology, exemplified, communicated, and supported by the political parties. Democrats, Keynesianism, you have the Republican Party, monetarism. Okay, so they're going to try to get somebody in to the chair position that's going to basically represent the ideology. the monetarist supply side ideology. The problem is the supply side economics does not have robust literature for policy effects and impacts. It just doesn't. It's basically voodoo economics to a certain degree. And monetarism works to a certain degree, but there's got to be a Keynesian component to it to make it more effective. And Keynes wrote a lot about interest rates and monetary policy. So there's what is called the yield curve. Okay, are you guys familiar with yield curves? Okay. Now, yield curves,
Oh, yield.
Okay,
Yeah.
yeah.
Nice.
I thought you said
Yield.
something else.
Yeah.
yield curve, so it's the
Yeah.
maturity on the bonds and the interest rates. This is a normal curve, upward sloping, which means that inflation expectations are higher in the future, and that people who want to lend money to the government want to be compensated for the erosion of inflation. So they add on an inflation risk premium onto it. So an upward sloping curve, it basically is indicative to growth in the economy. Those inflation expectations in the future basically push up the yields on the longer dated bonds, which means that the market itself is anticipating higher growth and higher inflation in the future. Okay. Now the problem is, or the dynamics of the yield curve, is that the yield curve can flatten and it can invert. Okay, so there's basically, it's dynamic. It goes like this over time. And I'll show you the dynamics of the yield curve and why it's so important to watch it on a daily basis. Because I might as well just go right to the demonstration. And a lot of what I'm showing you right now and teaching you right now is the stuff that I teach my students. Because I usually start with the yield curve in my classes. Because all the securities analysis and real estate analysis and all the valuation work, basically it flows down from monetary policy and the yield curve. If I'm gonna figure out how much yield I want on my real estate or my stock investments, I'm gonna, let's say my holding period is 10 years, I'm gonna use the 10-year treasury as the risk-free rate and then start adding on risk premiums to get to my expected return on my discount rate, to discount it back to get the present value, or net present value, or internal rate of return at the end of the day. So it's really important to understand yield curve theory because it's the base rate that determines the discount rate going up and down for valuation purposes. So let me go back and then I'll go to this because I think I want to make sure that you're have some fundamental grounding in my approach. So this is the two income approaches to valuing real estate or stocks, right? You got dividends or earnings per share, net operating income divided by the cap rate. So if net operating income goes up, valuations go up. If the cap rate goes down, valuations go up. Net operating income and net operating income over the holding period is highly correlated to the business cycle. So if I know where we are in the business cycle, I can forecast NOI and figure out what the valuation is going to be. The hard thing to predict is the discount rate, is the cap rate, or the discount rate, or your expected return. That's what's really challenging. So what I figured out was, well, I can predict this and know what the effect on this is, but it's really hard to predict what the discount rate is. And the discount rate is more volatile now than it's ever been before. The implied discount rate, the implied cap rate, is more volatile now in history than it was 30 years ago. So it makes valuation extremely more difficult. And because you have volatility, you have boom busts. You have bubbles and then they pop, okay? So there's more risk because this is more volatile now than it's been before. And then again, obviously, if you're gonna build your expected return that becomes your discount rates, the risk-free rate is in the equation twice. So if this goes up, that goes up, that goes down, okay? And vice versa. So the risk-free rate is really important to figure out what's going to happen to valuations in the future. So let's go back and go look at the yield curve in a dynamic fashion. So you may want to write this website down. It's stockcharts.com. And you could just go into Google and type in dynamic yield curve, and that website will come up. You click on it, and this is what you have. So here's the yield curve right here. Okay, and this is the S&P 500 index. Okay, and what's going to happen is this is going to start moving around over time. So you're going to, and this could be, real estate price index easily. So what you want to look at is the relationship between the yield curve and stock prices, and this could be real estate prices too, over time. And you can see what the Federal Reserve is doing over the business cycle. If they've done it before in the past, they're going to do it in the future. Okay. So you hit animate there, and you can see how flat the curve is, right? And as you start to approach the peak in 2000, what you're going to see is the Fed's going to start selling bonds and start driving up short-term interest rates. And then all of a sudden, the curve is going to invert. So it's steep, normal, flattens, and then inverts. Once it inverts, boom, you're going into a recession. Then what the Fed does is to put a support under asset prices, stimulate the economy. They start to print money, buy the bonds, drive up the bond prices, and start driving down short-term interest rates to lower the cost of capital, particularly for corporations that borrow on the short end of the term structure. So you can see how aggressive they were here. And then they buying, keeping the curve really steep to lower the cost of capital and try to stimulate consumption and investment. Then at some point in time, the economy starts to recover, inflation expectations start to be reintroduced into the market, and then as you can see, the short-term interest rates start to move up again. As we start to approach the peak again, as you can see, the curve is starting to flatten. And then watch, tell me when the curve inverts. Oh, it looked like it inverted right there for the first time. It inverted a little bit, and then watch right, probably there it inverts, boom, about a year before the peak. So by watching the yield curve, it's basically going to tell you when the market's going to peak. So most of the stock market peaks, once the curve inverts, the market peaks within 12 months. And we're in a recession within 24. Then this time around, which was different, because the Fed was printing trillions of dollars in money to buy up everything, not only sovereign bonds, but corporate bonds too, and just sucking that stuff in. They went to zero interest rate policy. Germany and Japan went to negative. Their yield curves were down here. Their 10-year was negative. So their approach to quantitative easing and monetary accommodation, extremely aggressive. We never got that aggressive, but in the next recession, because interest rates are still really low, Yellen has already told the banks to do stress tests on a negative interest rate environment, which is horrible for savers. Right? Anybody that's buying bonds or retiring, or anybody who's putting money in a bank, or putting money in short-term instruments, you're basically losing money when you get negative interest rates. So it's horrible. And then you can see that the curve was not only steep, but it also started to come down. So the Fed started pushing longer term rates, and a lot of foreign capital was coming in at the same time, because they were looking at 2-3% on 10, 20, 30-year bonds, and they were getting negative in Japan and Europe, and they said, I'm going to the United States. But here's the problem, is the yield curve is still extremely steep. We've already punched through the resistance line on the stock market. The yield curve is still very steep, and we're basically potentially in a stock asset price bubble that will only eventually pop at some point in time when the curve starts to flatten and then invert. So you can see that the rates have started to move up on the short term. Rates have started to come down on the long end because the Trump trade has basically been wrung out of long-term rates. The Fed has said that they're going to continue to raise short-term rates. So if the Fed is raising short-term rates and the Trump trade is pretty much over on the long end, the curve is starting to flatten, okay, which is the first indicator, right? Then the Fed has also said that they're gonna start selling off the balance sheet. They have $4.5 trillion. Half of that is in US government securities. The Federal Reserve has held historically $700 billion to $1 trillion in US government securities on their balance sheet to conduct open market operations to regulate bond prices, interest rates, and stimulate or cool the economy. They have basically 4 times that, right? So they need to unwind the balance sheet. What does unwinding the balance sheet mean? It means selling off government bonds. Well, if the Fed is raising interest rates, right, and short-term rates are rising due to interest rate rises, long-term rates are falling due to lower inflation expectations because Trump can't get anything done, and the Fed starts unwinding the balance sheet, and the majority of those securities are short-term instruments, short-term securities. As they start to unload these bonds, it's going to cause short-term bond prices to go down and interest rates to go up and increase the probability of an inverted curve. Probably by early next year. So a year later, January of 18, January of 19. Maybe the effect will hit in April of next year, 18, April of 19. So just another confirmation on that potential recessionary scenario. So that's my thinking on interest rates. And that flows right through to residential mortgage finance, because the 10-year treasury is the index rate. And residential mortgage interest rates, 30-year fixed, basically tracks the 10-year treasury with 150 basis points. So if I see the 10-year moving up or down, I add on 1.5 percentage points, I can get to the 30-year fixed mortgage rate. So I can actually forecast mortgage interest rates using the movement in the 10-year treasury.
Very good.
Yep.
Now we're at 8% of the properties on rental are it's 8% that it's down to now for deductions in rents because of
the effective, because of the concessions on the free rent, particularly luxury in San Francisco. I've taken the biggest hit.
Yeah.
On rental.
Yeah, I know one of our broker agents sold a lot of property condos, and she can't unload them for the life of her.
Oh, really?
Yeah.
Did she buy them as inventory, or did she?
For her clients.
Oh, okay.
Yeah, so
they can't unload
clients,
them.
yeah, no.
Well, the prices are too high.
Oh, God, they're nuts.
Yeah, and the employment market here in the Bay Area has started to slow. We've been running at about, just here in Marin and San Francisco, San Mateo County, we're still running at around 50,000 jobs, which is very healthy, actually. But actually the rate of growth has dropped from around 5% to 2.5%. And one of the reasons why the growth rates have started to slow, because our unemployment rate is 2.4%. So we're basically at full employment, or frictional employment, even though there are people that are underemployed and there are people that aren't participating in the labor force. So the unemployment rate is kind of an artificial number. I use underemployment, which is double the unemployment rate, as really the true unemployment rate. You want to factor in people who aren't participating and people who are underskilled, are overskilled, overeducated, but working in lower skilled, lower educated jobs. Because they're having a hard time getting back into the labor force.
Now, I've been noticing, I don't know if you follow this, but I've noticed a lot of, and I'm sure it's overinflated pricing going out, price dropping in asking prices for property. And this is going, mostly I see it happening in Marin, and I see some parts of San Mateo County.
Well, they were probably overinflated.
That's what I was saying.
So they're just correcting from a frothy market. And if they're correcting now during the summer, which is the seasonal selling season, then what's it going to be like in the fourth and the first quarter? You know, this year and next year, because those are the softest time periods here. And who knows, if people start running for the door, right? They're going to start putting some inventory on the marketplace, which would be good for us, right? You know,
well, they're saying, and this is logical, of people who had money when property was dirt cheap, bought and have no incentive to sell it because they're getting good income on the rental.
Yeah, yeah. The only incentive, and I can talk about this too, your only incentive to sell is having an alternative to buy.
And where are they gonna go?
Where are you gonna get in? I mean, shit, if you zeroed out your basis on the recapture because you've been taking depreciation and you got huge capital gains, recapture is 25%, capital gains 20, that's what, 45%, 10% recapture, that's 55%, plus Obamacare and other types of add-ons, you could be at 65%, tax rate, net of proceeds. So you're really stuck into having to do a 1031 exchange. And I say if you zero out the basis, you've held the property for 15, 20 years, you're stuck into an exchange. The question is, what do you exchange into? The problem is they go after yield and cap rates in Phoenix and Albuquerque,
Yeah, they're not doing
maybe
well.
triple nets, okay, which is extremely dangerous. To have all of your eggs in one basket in a triple net in a highly competitive commercial market. Or you're chasing yield in a commodity market like Phoenix, right, which is susceptible to boom bust, on the demand side, and oversupply on the supply side. So you could get completely wiped out, if you don't do it right. So I say go ahead and do the 1031 exchange, and if you're young enough and smart enough, ambitious enough, driven enough, put the money, or maybe you're part of the family, you put the money in multiple assets, and you distribute the risk across maybe property type or sector or geography, and then you set up a management company and take 10% off the top into the management company, and now you can pay yourself a W-2, income, bonus, I can deduct my car, part of my rent, utilities, if I got kids that want to be in real estate, send them to college to study business, I can deduct their tuition. I can get other assets under management to build my asset management company. I can create an investment company based on those assets if they want to sell. I can launch funds. I can do all kinds of stuff if I start to scale. And if you look at, the Shorensteins that have been around for 50, 60 years, Ellis Partners has been around for 30, 40 years. You look at kind of the model, private equity model that's been laid out over time and how they've done it over time. It takes a long time to do it, but I think the smaller guys can take advantage of the same structures. If you want to get out of real estate totally, you do the triple net, which you got to be able to underwrite those properties in the markets. You can also exchange into oil and gas hold interests. Under the IRS code, you can exchange into those. But those are kind of like roach motels. You can get in, but it's hard to get out, right? And then you roll over. And then you have to, hello,
Hi.
how are you?
Late a bit.
Yeah, are you here for
The
the
seminar?
lecture?
Yes.
Yeah, come on in.
Yes, we don't have much time though. We've got
That's-
just a few minutes.
Yeah, that's
Don't
fine.
need to come and leave fast.
Yeah, no, that's fine. See,
Okay.
I'm going over exit strategies on the 1031 exchange.
All right.
Okay. And I've already gone through, if you want to give me a call or meet with me again, I can go over the business cycle and over economics, fiscal policy. But I like to start at the macro level and then come down.
Right.
So I'm going through right now basically the exit strategies on the 1031 exchange. Because if you own property and you depreciate it, you got a huge recapture tax. And if the property's appreciated, you got a capital gains along with it. So you got to do the exchange. Okay, and I say go ahead and diversify across multiple property types and create an asset management company. Because you can take some of that money, put it into a defined benefit program or contribution program. So there's a lot of ways that you can take that money and do other things with it and diversify that income, share that income out of real estate, okay, into operations. Yes, there's the triple net. You can also do exchange the proceeds into oil and gas leasehold interests, but you're going to have to underwrite the sponsor and you're going to have to underwrite the security. Okay, and again, what happens later on when they've depleted the whole thing and you need to roll over, you probably need to roll over into another oil and gas leasehold interest, or you can exchange from the property or the oil and leasehold interest into a syndicated tenants in common. under the IRS code, you can exchange into tenants in common. Again, you gotta underwrite the sponsor and you gotta underwrite the deal. The fees are usually pretty high, and if they've over leveraged the property and you go into a downturn, you could lose all your money, okay? But you can exchange into that and offload the management. You can also go into Delaware statutory trust. Okay, under the IRS code, I can exchange into that. They're very similar to TICs, but just different types of ownership and tax structure. But under the IRS code, you can exchange into Delaware statutory trusts. But again, you gotta underwrite the sponsor and you gotta underwrite the security, you gotta underwrite the deal. You can also do a reverse exchange. Okay, not a straight exchange where you sell the property and you got 180 days to basically identify and close on the transaction. With a reverse, you basically already bought the replacement property.
I thought you had to identify the property before.
In 90 and then you get close in
Okay, yeah,
180.
yeah.
Okay. By doing a reverse, it's more expensive if you gotta have the upfront cash, but again, you don't have the time limitations. You have more flexibility on that, so that's another strategy. The other strategy is the deferred sales trust, which is basically now a standard in the 1031 exchange, the uplay forward exchange strategy, where you basically have a stipulation in the exchange agreement that basically states that if I'm running out of time and it looks like the exchange is gonna fail and I'm gonna have to pay all of those taxes,
For years.
then what we do is we throw the property into a trust, an irrevocable trust, into a deferred sales trust, and it basically becomes an installment sale. So the proceeds from the property basically get paid out in an installment contract, and you only pay the taxes as you take the income on an installment basis from the trust. Okay. And then the last one, and there may be other ones out there, but those are the ones that I've identified as the exit strategy. The last one is called a coupled installment sale. Is that right? A coupled, I think it's called a coupled installment sale.
Not too sure.
Coupled, I think that's what it's called. I'll have to look it up. This one's a little bit interesting too. It's a tax strategy. I think it was developed in the mid-80s or mid-90s. That basically what you do is you contribute the property into this structured coupled installment sale, this coupled sale. There is basically the accommodator, which is the exchange company, and the bank. And the bank basically, you basically take out a personal line from the bank in the amount, the loan, in the amount of the value of the property. Okay? And then the property is put into this accommodator account. The property is sold. The proceeds are reinvested in securities, and the income generated from the security matches the mortgage interest payment. So basically it ties together. Then you, as the principal, get the proceeds from the bank as a loan. Okay? So now I got all my money out, tax-free, for 30 years. And I gotta pay the taxes in 30 years from now. So I get to use all my money over the next 30 years, but I gotta pay the tax liability in 30 years. So that becomes a trust, right? And I say go ahead and do it if you're comfortable with the structure, because it may be the only structure that's available to you if you can understand it and you're willing to take the risk of implementing that structure.
And you burden the trust.
You burden the trust, but you can actually, in my view, you can immunize the trust by using long-dated annuities and life insurance, if you're insurable. So I basically do the actuarial, figure out what the tax liability is gonna be in 30 years, and basically buy life insurance to basically extinguish the tax burden when it comes due. So whatever the net proceeds are, net of the annuity investments and the cash value life insurance investments, that's the net proceeds that I get to take away. So this is called synthetics, where you're basically piecing together multiple financial products with tax and trust strategies to basically find the solution. So it's multi-layered product strategy solution to solve the problem. And in most cases, we can solve the problem. It's just educating the clients to which they feel comfortable, and then educating their tax, trust, and business attorneys and accountants so that they can sign off on the strategy and then be able to then move forward to solve the problem. And if you want to invest in real estate, you can go back, you can go into it, where you can buy, I don't know, commercial mortgage-backed security mutual funds or exchange-traded funds. You can go into REIT, ETFs, and closed-end, open-end mutual funds. If you're accredited, you can buy into these crowdfunding platforms. You have to make a certain amount of money and have enough assets to be able to participate on that side. So there are other securitized ways of exposing to the real estate market with yields. You can buy seconds, you can buy first, you can buy portfolio, first and seconds, depending on the sponsor. So there's other vehicles in the real estate capital markets that will give you the exposure to the real estate and the yields that you want. But again, you got to underwrite the sponsor, the security, and the underlying collateral. That's going to support that vehicle. Any general questions? No more? Nothing else? Did I answer pretty much what you were looking for?
You covered a
Yeah.
lot in a short period of time.
Yeah, how long was that? That lecture? Because we started,
About an hour.
yeah, so an hour's good. I mean, I don't like to
Yeah.
go longer than that because it just drags on.
And you can send,
Yeah,
you
I
can
know.
send us the deck, right?
I'll send you the deck, and then
Yeah.
Derek will follow up with you too,
Sure.
to see if you have any personal
Yeah.
needs or requirements, and
Yeah, no questions right now. I think I just need to wrap my head around everything that was presented.
yeah. But my recommendation, I mean, are you married or anything?
Next month I will be.
Okay,
yeah.
you might want to get life insurance from
Yeah.
Derek,
Well,
to
that's
get
fine.
that done.
Yeah.
And the insurance is really powerful, because I got one of my students, I've known her for almost 20 years. She just got funded $25 million, in a startup. First thing the VC dude said was, "Do you have? We need $4 million worth of life insurance on you." So to get and lock in the life insurance allows you the flexibility, so that if any of those opportunities come in the future and all of a sudden you get a pre-existing condition, you can't use the life insurance.
Yeah.
So you might have to take a hit, on the valuation or dilution of your interest, because the investors are taking on more risk. By having the life insurance, it gives you you run the risk of getting a pre-existing condition. Once it's in place, they can't take it away from you. And then if you make a bunch of money, you can convert the insurance into cash value life insurance and start banking some money in the cash value that accumulates tax-free. And if something happens to you, the death benefit goes to your heirs, takes care of everybody tax-free. So it's where else in the marketplace, I tell my students, where else in the capital markets can you control $1 million asset for 30 years for less than $1,000 a year? So you're renting basically the asset. There's no other place. It's really powerful insurance. Did you have any questions or anything burning
Not at
desire?
all. No, I think you encapsulated it at the end, which is where we showed up.
Yeah,
You
good.
know what I mean?
So
And
that was
then,
really the strategy piece.
Yeah,
What do you
I
do?
really heard it.
What do you do? What do you do?
I advise on trusts.
Do you?
actually.
Okay, great.
Yes.
Great.
So, I act as an advisor
Do you?
with a few
Okay.
different trusts.
Are you an attorney?
No.
Okay, so you oversee trust assets and strategies
Yes.
and make sure everything's done right and there's no risk or.
Yes, in the
anything like that.
reverse, mortgages and rebuying, capital gains taxes and so forth.
Oh, you might want to also meet my partner, Roman Polnar. He's our senior advisor. He's a really great guy. Works really well with people. He may be somebody that you might be interested in talking to.
Okay.
Yeah, because he does high level planning.
All right, that sounds interesting.
Yeah, he's really good. And then I'm the real estate expert, and then Derek's the insurance expert. We both do annuities too, but I brought in the real estate expertise that rounded out the whole picture, as opposed to being real estate without the advisory, financial advisory, or financial advisory without the real estate. So I think we have a unique perspective that we bring our clients.
Good, thank you.
Yeah, you're welcome. And then did you have any questions or anything? No? Okay, great. We'll take our business cards. I'll give you your business cards and I'll send you the deck. And then we'll schedule a call and hopefully customize, more information and, more than happy to share. And then our next one is what?
Following week, I believe.
Next, isn't it next,
Thursday.
next Thursday? So if you wanna come next Thursday, I'll do the lecture again.
Thanks, Rob.
We'll be in contact, thank you.
Excellent,
Green couch.
great, thank you.
That isn't my real estate, but it's my notary.
Oh, okay, great. And then where's your office?
I'm mobile.
Oh, you're
Yeah.
virtual, good for you. Oh, that's awesome.
Is
Yeah.
there, do you need a key to the restroom, is that?
No,
Oh, okay.
no, you're good. Do you want some water or something to take with you?
Sure, I'll take some.
Do you have like a glass of water or maybe?
Are you okay with sparkling?
Yeah,
Thank you very
Nice
much.
to meet you, yeah.
Appreciate it.
Yeah, you're welcome.
sure. Yeah, and where do you teach? You said you teach.
I got done with state,
Mhm.
so I was teaching real estate there.
Okay,
I teach at Golden Gate in the graduate business school.
okay.
Finance.
All right, yeah.
And then I
Golden Gate.
teach at St. Mary's, where Derek just graduated from.
Congratulations.
So I teach corporate finance, international, and investments.
You graduated just when the bridge broke, huh?
What's that?
The bridge went out?
You know what? I've been living in Santa Cruz. I didn't even hear about that.
Oh, yeah, during the floods, one of the main arteries into Moraga.
Yeah, in Moraga.
Oh, you mean when the gas pipe exploded?
No,
I think-
this was flood washed out one of the bridges.
I didn't even know that, to be honest.
Yeah.
So you can get to St. Mary's from multiple directions.
Yeah,
Oh,
yeah,
so
you
maybe
can come
that's
in back
why.
from Lafayette and then, Oakland, I
Yeah.
think, with
Oh,
13?
through
There's a
Canyon?
couple ways
Yeah,
to,
yeah,
Through the Canyon Road.
yeah,
Okay, so yeah, I knew that was blocked up. I didn't know that's the reason why.
yeah.
and I also teach at USF.
Oh, okay,
University of San Francisco.
Yeah.
So I was at 4 universities over the last year.
yeah,
And I'm gonna be down to St. Mary's and USF over the next year, because I got business stuff that's taken off and I just can't
yeah.
spend as much
Struggling,
time with
yeah.
the students.
Okay,
All
well,
right.
it's a pleasure.
Yeah, you're welcome.
Yeah, thank you.
for stopping by.
You're welcome.
We-
Oh,
you know,
okay. Yeah.
Great. Thanks again. Is that?